Can you see it?
Yes.
All right. We also have a Slack channel that we added. So obviously we're going to talk about periodic average costing. So this is first of our 2 training sessions that we have planned for, the next one being on Thursday. We'll talk about what we will cover in these 2 sessions. But in the meantime, the trainee put together this public Slack channel, #cloud-pac-costing. So if you have any questions, feel free to put the message out in the Slack channel and one of us will respond. Right? Okay. Getting into, so there's a safe harbor, folks, and I know a lot of you are working with customers. So this is what we are talking about is still a future product direction, though it's pretty near term, because we're talking about 22C and 22D, which are what we usually put in the second column of our standard roadmap, which is next 6 months. But it's still subject to change. So please keep this safe harbor in mind. So though we think that we are in a pretty good shape at this point to get our ducks in a row for 22C for our general availability, and we'll talk about what is coming in the next couple of releases. Agenda for today, we're going to spend say 30 minutes on giving you all an overview on PAC. I do not know the profiles of folks who are in this call. So by a show of hands, if some of you can tell us how many of you are familiar with cloud cost management. That way we can tailor our conversations, because otherwise we might make incorrect assumptions about how much you know of what our current functionality does. So if you can actually just raise hands if you know cloud costing. All right. So there are 82 participants, so only 2 have raised hands, so which means 80 participants don't know. So
yeah, it's true. Many of the participants are at least from Oracle, are from the sales consultant team and from OCS with previous experience in cost management. Also, we have a presence from partners, especially in Brazil, that also we previously checked that they have no knowledge about cost management to enter in this course.
All right. Okay. Let's see how many. I'm not able to see since I'm sharing my screen. So can somebody give me a count of how many participants raised hands?
We have around 7 or 8 right now, Kaushik. So
got it. Okay. All right. That's a small number of people who might be familiar. So we'll kind of keep it slow and then try and explain these concepts as we go. Okay. So agenda, we're going to, like I said, these are 2 90-minute sessions, and we will cover all of what we are talking about in 2 sessions. In let's say half of today's session, we're going to talk about a costing overview, especially with periodic costing. And then we'll take it over from there. And then I think Siddharth picks it up, right, Siddharth, for setting up PAC. And then Srini will take it over from there for cost processing with examples, which will be purchasing, inventory, transfers, adjustments, which are unique to PAC, and then period in processing, right? So not everything will be covered in today's session. So we will also have another session that would be planned for me. That's actually on schedule for Thursday. So we'll go from there. You might notice that we are not including manufacturing at this point because it's still under development, and we will find a different session to talk to you guys about it later, right? Maybe as part of the larger training or something like that. So that is not part of agenda for today. So any questions on this before we go forward? Right? Okay. I mentioned to you all that we have some things coming up. So just to give you a sense of where we are. So as we speak, we are in code development for 22C. So this is the release. 22C is the release, which is where we are hoping for a general availability, right? So I think some of you have on some emails in the past have asked, oh, is there an early adopter thing? No, there's all customers who want to use PAC will start using PAC from 22C, not before that. Okay, just be clear about it. So just to give you a sense of what we did, most of our code work started in 22A. So we finalized our requirements and design prior to that, and in some cases during this time window. We finished our setup. So you're going to see what are the setups that are required for PAC to make it work. most of it is within the confines of what we already support in Fusion, and we added some tweaks to make it work for PAC as well. So we'll talk about this more in detail. So that got done for 22 by 22B. We did inventory, purchasing, transaction flows for PAC purposes. Inventory flows are things like miscellaneous transactions and so on and so forth. And purchasing would be obviously receipts and returns. And then, like I said, adjustments is a concept we will talk about in more detail. So these are PAC cost adjustments, either as a lump sum adjustment or as a unit cost adjustment, which are costing generated transactions. We built the REST services for it, and we're building the UI for the same thing in 22C. 22C is where we have actually, I think for most part, we've done transfers, and then we're going to show this to you today, or it might be today, transfers potentially. And then manufacturing is something we're building, and then there's OTBI enhancements that we have to make it work for reporting purposes. In 22D, you might notice that there are some spillover items, and you can imagine these to be more advanced features in manufacturing. For instance, as part of manufacturing scope in 22C, we would offer scrap as inventory. What we are also adding in 22D is scrap as expense. In 22A, manufacturing came out with a project called resequencing operations. And obviously it's a very recent release and you may not even have customers using it. So for resequencing, it has costing implications. So part of some of those kind of things would be done as part of 22D. And then in OTBI, we are seeding some additional reports for making it easy for our customers, especially around resource absorption, etc. Right? So there is still some work for us to do in 22D. So as we go, as we get into more details of this view of the solution, you can understand what is included as part of 22C. But the larger message for you folks to take away from this call is for both distribution as well as manufacturing customers, whether it's manufacturing, maintenance, or process manufacturing, we should have a solution by 22C. What's actually deferred is only some of the advanced ones like scrap as expense and resequence operations and so on and so forth, right? So we have a fairly good solution at the end of this release. And then in 23X, X stands for a release unknown. We would do some work with expense allocation. We haven't talked about this. It's not the highest priority for us at this point in time. And this is where I think we, in the call that we had last time, we mentioned that there's a possible partner play in this area. By expense allocation, what we mean is you can take a GL cost pool and determine what your overhead rates and resources need to be, and use our REST services to upload the data. So the calculation of the fee itself is something which we're not automating as part of the solution. It didn't exist in discrete PAC. It did exist in OPM though. OPM PMAC did have it, but PAC did not have it in discrete. So we didn't think it was a big enough scope item for us to take on, because the more important thing for us is to get to the heart of cost processing with PAC. So if you have partners who might be interested in building a PaaS solution for this expense allocation to determine what the rates are, that might actually be a good idea. So like I said, general availability is 22C. There's going to be a permanent opt-in. Customers who can opt in to PAC can just start using it from 22C forward, which means any new customers can just adopt the solution as it is. They can just get to go and go from there. I don't know if this applies to you in Brazil especially, or LAD for the matter. So you might have some customers who may have gone live, say, a year or two ago on a non-PAC primary cost method. Now, if they want to make a switch and make PAC as their primary cost method, then they have to work with us, because you cannot, as a user, make changes to what your primary cost book is. So you'd have to work with us. But if they want to enable PAC as a secondary cost book, they can still go ahead and do it. So you don't need our support for it. All right. And I think I mentioned this before in another forum. We don't intend to do iterative PAC for cost-based transfers, and we'll explain how we handle cost-based transfers in our solution going forward. Any questions on this slide? I see there's one chat. Okay, will it be recorded? Alfonso, that's a question for you. So, as a user, make changes to what you
the presentation is recorded.
But if they want to enable PAC as a secondary cost book,
if we will share the presentation and recording needed, yes, we will try to make an error doc for the information.
All right.
All right. Go ahead. I don't know if someone has a question specific for these points that Crowdcheck is speaking also. I will put on mute, okay, the rest of the audience. Crowdcheck.
Okay, anyone not talking can go unmute themselves. Yeah.
Please, just one question.
I think you still have to put it yourself, everybody on mute. You own the session, so just mute forcefully everyone.
Why you are saying so? Because this is an approved.
Okay, I am unmuted. Okay, if there's no further questions on this, I will move to the next slide, which is giving you a sense. So some of you might be familiar with this, some of you may not be. But this is to level set what we call as periodic average costing, which is what we call PAC in the cloud construct. So unlike any other method of costing, which is what is typically known as a perpetual method of inventory valuation or costing, every receipt transaction changes your, let's say if you're using average costing or if you're using FIFO as a basis, every transaction changes your cost basis, right? In PAC also it does the same, except that not every transaction influences the issue cost, which means in PAC, what we do is we lump all of the transactions for a given period of time. In this case, there's an accounting period. So whether it's a pure receipt or whether it's in-transit transfers, with completion, so on and so forth, we call these as cost-owned transaction. You're going to actually start seeing this terminology in our demos as well. So what we do is we lump all the cost-owned transactions for an accounting period. We perform a periodic cost calculation and then determine the periodic item costs. At a very simplistic high level, this is what we do. So every receipt of an item within an accounting period is lumped to calculate the cost. So let's say if I received 10 units at $5, another 10 units at $6, your total cost is 50 plus 60, which is $110 for a total of 20 units. So therefore your periodic average cost for that item would be 5.5, right? Now, all issue transactions, which is what we call as cost-derived transactions, will take the 5.5 as the basis. So an issue transaction could be an issue to a work order or a sales order shipment, etc. Right? Now, this is the high-level construct for PAC, and obviously there's more devil in the detail because there are related transactions. For example, a WIP issue or a component issue for a manufacturing work order influences the product completion cost, right? So how do we handle those kind of situations is the beauty of the design, right? So we'll get to that when we get to it. But the idea largely is that in a periodic average costing, we will do average costs on a month-to-month basis or a accounting period to accounting period basis to be more precise, right? Now, the reason why some customers adopt for periodic average costing is, let's look at this, right? So some of them, it might just be complying with a fiscal reporting requirement, right? A fiscal reporting requirement might say that all of your expenses have to be absorbed into your cost of product, right? In which case you need to wait for end of the month to fully absorb the costs, because some of these costs are only known end of the accounting period, right? So that's why in some cases, PAC is also known as a full absorption costing, because you're able to wait until the end of the period to determine what your overhead rates and resource rates would need to be. And therefore you would absorb them when you know the values, right? As opposed to another method of costing where you're estimating what the rates are going to be. This doesn't mean that in PAC you cannot estimate. That's the beauty of the solution, where we actually will let you even use a prior period value or whatever the user might update, and we'll let you simulate it as many number of times. But end of the month, when you're ready to determine what those finalized rates are, you can put them as different resource rates and different overhead rates to get your absorption fully done for those cost pools, and then that becomes the basis for calculation of PAC, right? The other key difference which we already called out is inventory is valued on a periodic basis, right? So it's not every receipt changing costs. It is actually all receipts in a given period changing the value of inventory, right? In some cases, let's say if you're trading in commodities, gas is a good example of late. The prices might vary significantly between start of the period and during the period or end of the period, or you might have a inflationary situation where your currency actually fluctuates to a point where your start and end period rates are fairly significant. In such cases, having an average for a period will kind of smoothen the impact of price changes, whether it's due to currency or whether it's just due to price changes itself. And therefore, all your issues kind of get a standard rate for the item for the period, right? So these are some of the benefits, or these are some of the value propositions that we have. So it might be a fiscal reporting requirement, which helps you with, which might mandate a full absorption cost. It helps you smoothen the impact of price or currency changes, and it will also help you value inventory on a periodic basis. And these are some of the high-level value propositions. I think most of you might know this concept, but I just wanted to level set in case you weren't aware of it. You had a question? Okay, a miscellaneous transaction with own unit cost, and will it be considered for a cost-own transaction? Yes, the answer is yes. So we will take that question as we look at some of our demos also. So a user-entered cost for a miscellaneous transaction will be considered as a cost-own transaction, even if it's a miscellaneous issue. Okay. Moving further. All right. Now, when you talk to your customers, and this is sort of, the slide helps you highlight our solution, right? In costing, we support multiple work methods. By work method, what we mean is there is a discrete manufacturing process. There is a process manufacturing situation, or there might be rework, or there might be transform, or there might be maintenance work orders. We don't make an exclusion as far as PAC is concerned to any and all of these methods, which means whether I'm a discrete manufacturing customer or a process manufacturing customer, or I'm a mixed mode where I have both discrete and process, if I'm using enterprise asset management, in all of those situations, you can actually use PAC, and this will work across the board, right? So all work methods are covered as part of our solution. We already talked about this being a full absorption costing. And the ones in parentheses is just to highlight the fact that in EBS, we used to have periodic average costing, we call it, which was supported for discrete manufacturing. And then PMAC was more for process manufacturing and OPM, and then we didn't have any support for EAM separately with PAC. Now, what we have done in Fusion is we've consolidated all of them in a single cost engine, which supports all cost methods and all work methods, I apologize, across these different methods of manufacturing or maintenance, right? And when we considered our solution for PAC in Fusion, we're calling it PAC in Fusion. We're not calling it PMAC or something else. PAC was simple enough for us to use. It incorporates the salient features of both periodic moving average cost as well as periodic average cost of discrete, right? We'll talk about some of the comparisons in a slide to follow. Now, I mentioned to you that your customer can use PAC as a primary cost book or a secondary cost book. A primary cost book, think of it like a cost book where you can have PAC as the primary method of costing, which might map to your primary ledger. A secondary cost book could be imagined as a secondary cost book which uses PAC. Primary might be standard or actual, which is FIFO or perpetual average. And you can use PAC for your secondary cost book and map it to your secondary ledger. We would support both. And we don't limit the number of cost books a customer might need to have. The idea behind having primary and secondary cost books is what we call as multiple representations of cost. So when you have, let's say, if you're a US company, let's say Tramontina, which is a US-based company which has operations in Brazil, they might choose to use two books, one for, say, actual or average costing, which will be used for SEC reporting for GAAP purposes, and then they might use something else for local Brazil reporting, right? In which case you will set up two books. It's almost like if you're familiar with the concept of primary and secondary ledgers in general ledger, it's a similar concept, but the enhancement that costing has made on top of what we had ever in EBS is there is a notion of a secondary cost book where the cost method itself can be different, right? So which is why PAC can be used for your primary or secondary book, which may map to a primary or secondary ledger. And you can also use it for a ledgerless book, which means if I'm just using it for analysis purposes, I could use it there as well. So that's the multiple concept of multiple representations of cost, right? So I think I mentioned to you earlier on that if your customer is a new customer and they want to implement PAC as a primary cost book or a secondary cost book, they can just go ahead and do it. But if it's an existing customer who is using some other method of costing or cost book for a primary, and they want to switch to PAC for the primary accounting, they would have to work with us in such cases. So on a case-to-case basis, we'll evaluate it. But for all other customers, whether it's a new customer or an existing customer who just wants to enable another book and run with it, there's no reason for us to get involved. And then there's a notion of sharing costs. Okay. So by this, what we mean is in costing in Fusion, we have what we call as valuation units, which helps you determine at what level you're costing an item. For PAC, we'll support two levels, which will be what we call, which is inventory org, which is the lowest level of granularity when it comes to periodic average costing, which means an item at an org level can have its own periodic average cost determined. Or you could combine multiple inventory orgs into a cost org and value at the cost org level, right? So that's another possibility. The equivalence of this could be, you can think of it like if I have a legal entity, which in some sense is represented as a registration number, CNPJ numbers in Brazil, for instance, you can actually determine that there might be 5 warehouses you might have for that CNPJ, right? And you might choose to have one cost across these 5 inventory organizations because the CNPJ number is the same, in which case you will actually end up creating one cost org, which will include 5 inventory orgs, and you'll set up your valuation units to have all 5 cost org inventory org combinations will be part of the same valuation unit, right? The equivalence of this in EBS, we'll talk about it in another slide. So EBS will let you do valuation at a cost group level. So think of it as a rough parallel to what we had from EBS in that sense. But this is a lot more configurable. And this is not just for PAC. You can do it for any other method of costing also. And we talked about full absorption, right? Again, to reiterate, for full absorption, you can set up your overhead rates, or it can cascade down from whatever you had in a prior period. You can keep changing those rates during the month or during the accounting period, as long as you're not close your books. It helps you assimilate what your cost distributions are going to look like so that you can run some interim reports. And then when you know your numbers end of the month, you can determine the rates and throw it into the system so that the system gets you the full absorption cost. Now, this is where we talked about a partner extension, where if you want to calculate those rates using some cost drivers from a cost pool, then that could be a partner extension that they can come up with, as opposed to having to determine these rates on a spreadsheet somewhere else. All right, I see there are 3 questions.
I will mention that I'm seeing 3 questions, but I believe that trainee already answered one.
Okay, yeah, correct. So lower level valuations is not support. We don't intend to support sub-inventory lot serial project. That's for other methods of costing. For PAC, it doesn't make sense. Will the values initially estimated and later updated with actual values? Yes, Rodolfo, we would see that as part of our examples and demo as we go forward. So the idea is that if you have LCM, Oracle's landed costing piece, and you might get an invoice end of the month or even next month, we would change. I mean, obviously your cost basis or acquisition cost will change. Let's say you get an invoice in Brazil, probably it doesn't apply because your invoices come with your receipt, so it probably doesn't matter there. But if you have a landed cost situation where you're actually getting, say, a freight invoice which comes, say, a week later from the actual receipt, that could change your cost basis. And for calculations of PAC, we will consider those. And there is a subtlety in terms of what happens if you get it within the period and what happens if you get it in the next period. So we'll talk about that when we talk about purchasing transactions. Yeah, so we talked about, we will do it. Any other questions? I don't think so. Should we move forward? Okay, this is a useful slide, and I think we might cover this again as we go through some of our discussions when we do the demos. But the high-level flow of the data we wanted to represent here, and what is to be done during the period and what happens end of the period. Okay. So incoming transactions, right? Incoming transactions can come from different sources. You can have inventory, which is the majority of where transactions are going to come from. You can have manufacturing, where you might get things like resource transactions and work order close transactions, so on and so forth. Maintenance might similarly send you, maintenance work order close transactions, resource transactions, right? Now, when you get these incoming transactions, these are processed by costing, and what we create, we're not calling it draft in the system, but functionally speaking, we are creating interim cost distributions or draft cost distributions for it. Why it is draft here is because the value that you assign to these incoming transactions might change. The example that we just talked about, like if you have a landed cost freight charge or a customs duty that comes at a later point, it might change your cost basis, and therefore your acquisition cost might change, and we might have to redo these cost distributions again, right? But the idea of doing these cost distributions on a ongoing basis is it will let you review the cost information as you go, right? Another example, you may start with your overhead rates from a prior period. You may start with resource rates from a prior period. I know those rates might need to change, but you would want to simulate what those might be. And so you might end up revising your period rates as you go and recreate your cost distributions. We would end up purging those old ones and recreating the new ones, right? So that way, you can start looking at your numbers as things go. Now, the other reason why you might do this is you may get a adjustment. An adjustment could be, say, a lump sum adjustment, what we call as a value adjustment. An example of this is if I'm a retailer or if I'm a wholesale distributor, my supplier might give me a markdown, in which case I will have to bring down my value of inventory. That'll be processed as a lump sum adjustment, and that would have to impact your cost, right? So that's an example. Or for whatever reason, if you determine that your prior period cost or prior period PAC as calculated need to be changed, then it impacts the opening value of PAC, right? That's another form of adjustments that we would support. So we'll talk about that in more detail. But in all of those cases, the idea is that there is a process you can put in place to review these distributions as transactions start to come in, right? And this is within that dotted boundary line here, which kind of tells you that you can do this as many number of times as you want. Another thing you'd also care to do is to make sure that you're not hitting any exceptions, right? So there is a process we're going to talk about when we talk about period end processing, which where we handle some types of exceptions. For instance, if this is the first time you're transacting the item, and you want to transfer this item from org A to org B, right? Now, the transfer from org A to org B in our design will expect a prior period PAC as the transfer price basis. Now, if it's a net new item, that won't have a prior period cost, in which case it will be logged as an exception. You can review those exceptions and update the prior period PAC or an opening PAC for the item, and resolve those exceptions, go forward with it. Now, all of this we expect it to happen during the period as many number of times as it makes sense for a customer. But once you're ready to close, let's say if it is day one of your close, what you would want to do is to kind of turn this plug off, right? This incoming transaction plug. Why do you want to do it? Because if these keep coming in, then there's a lot of noise in the system and you wouldn't know what your final numbers are going to be. So what we are introducing as part of this solution is a concept of a pending close. So by putting a period in pending close, you're basically shutting the plug on incoming transactions, right? And then here is where you create your final cost distributions. Obviously, by this time, we have set up all of our rates and we've done a full absorption. And when you run the final cost distributions, you're actually comfortable and you can still go back and set your period to closed. You'd go back and you go and set your period to closed. By closed, what it implies is we're not going to let you change some of these rates on a closed period. The objective of doing that is when you're ready to finally account the transaction. So you might have noticed that we don't show accounting in this boundary here. The reason why we don't show it is because we only account when there is a final cost distribution that's out there. And what is final is determined on the basis of whether my period is closed or not closed, right? So if there's nothing else to do, we will do final accounting and transfer the GL. So this is the first time that you will actually be sending transactions to general ledger and doing a cost accounting from an SLA perspective. And then the period will be flipped to a permanent close. But a permanent close period can never be opened. And then it'll open the next PAC period for you. Which means at any point in time, you have one open period in PAC. And once you permanently close a PAC costing period, everything that you have in the prior month, which is in terms of open, the prior period rates, etc., are locked. You cannot change those period rates from a prior period perspective. All right, there are 4 questions I think have been.
Oi!
Okay, is there anything for me to call out, Srini?
No, Kaushik, I think we are doing okay. So you can continue. So we will keep responding.
Okay, all right. But if you want to use this opportunity to speak it out instead of letting people respond to the question.
So I think the question was what happens if there is a transaction that comes in a closed period, right? So like you just talked about here, you have a control in inventory where you can prevent these transactions from being created. But if you choose to create those transactions, then we basically slot it in the current open period. So if you create a transaction, let's say it's February, and February is closed, we will cost it with the 1st of March, which is a current open.
Yeah. Okay. Shall I move to the next slide if there's any no further questions on this? Okay, I think this might be useful for some of you who might be coming from EBS, and this was just to draw a comparison to how our solution is different or the same from what we had supported in EBS. By EBS, we included both PAC and PMAC, as I mentioned before, and this is the cloud column, right? So we talked about cost sharing, right? So when it is cost shared, we're talking about an item having a cost across multiple inventory orgs which are contained within a cost organization, right? In EBS, it was a concept of a cost group, which was sort of striped by a legal entity. So within one legal entity, you can have one or more cost groups, but a cost group will only have one legal entity as a parent. In Fusion, we're not doing legal entity, we're actually doing a profit center business unit concept. So a profit center business unit itself could be underneath a legal entity. So typically in a Brazil type implementation, we expect the CNPJ to be mapped as a profit center BU, right? If you only have one CNPJ, you could just do one BU, one profit center BU, which is under the legal entity. But if you have, for whatever reason, a legal entity which may have multiple registrations and different CNPJs, each of them would be a separate profit center BU, and then a cost organization that is sort of implicitly underneath the profit center. So therefore, you can only share costs across inventory orgs that map to the same profit center business unit. In EBS, it used to be under a legal entity, right? The other big difference with the accounting construct is we are actually leveraging the full power of SLA. SLA is subledger accounting, as far as PAC is concerned. So that we're doing for other cost methods, and we just kind of extending the same logic. The big difference, though, is when cost distributions are created during the period and the period is not closed, we don't create any accounting. The accounting is only created when the period is closed. So to that extent, we are managing within the framework that SLA supports and creating accounting distributions when the cost distributions are finalized, which is when the period is closed. In EBS, we did not leverage the SLA, so it was a very different, model. I mentioned to you that iterative processing is something which was supported in EBS, where cost-based transfers involved. And iterative is a situation where the same item is shipped from org A to org B, and the item can come back from org B to org A. So it's sort of a circular reference. The basis of transfer was cost. Now, in such cases, we had this notion of iterative processing where you iterate as many number of times as your cost becomes close enough. It was very performance intensive, and we didn't think there was much value in bringing it into the cloud construct. So we are excluding iterative processing, and for cost-based transfers, obviously we'll support transfer pricing. Transfer pricing is supported through financial orchestration today. But if it is not a financially orchestrated transaction, and it's, let's say, a transaction between orgs within the same profit center, for example, cost becomes the basis of transfer. And in EBS, there was also an option for us to use a prior period periodic average cost for such cases. So if during the month you're transferring an item from org A to org B, and they're both in the same profit center business unit, the cost basis of the transfer price basis for that will become a prior period PAC. So that's what we're moving forward with. So in other words, we don't intend on doing iterative processing for cloud, but we will. We had this feature in EBS which we're not intending to carry forward. So we talked about adjustments. So we will support two types of adjustments. Value adjustment is a lump sum adjustment, where you will add a value to the cost of the item, and then that'll be apportioned across multiple units of the item. And we would obviously allow you to do these adjustments at the cost element level, etc. And then we also would allow you to make an opening pack adjustment, right? So which means for whatever reason, if you have to make a change to the opening pack, you could do it. So these are two types of adjustments that we believe should cover every other form of adjustment that EBS supported, both in PAC as well as in PMAC. So PAC and PMAC had value adjustments, we will be supporting it. In PMAC only, there was a notion of adjustments with quantity. So this is something we don't intend to support. We didn't think there was a strong enough use case for this one. In PAC only, we could override a prior period cost, which is what we are doing as part of PAC opening pack adjustment. But they gave you two different ways in which you could do it. You could simply override the value, or you could actually process that as an adjustment. So what we are doing is we're just simply overriding the value, because it's just one way of doing it. End of the day, it still is an override. And then in PMAC only, we could override the current pack, which we don't intend to scope in Fusion. Right. So if you want to change something for the current period pack, you can process another value adjustment and then change it for whatever reason, but we don't think there was a big enough use case for this. Allocations, we talked about it. So in PMAC only, there was a concept of GL expense allocations. It was not very thoroughly built out even in PMAC. So when we do this in phase 2 of our project, we would probably think about using some other solution also, potentially an EPM kind of a solve as well. But this is where you have a partner solution that could be used and leveraged for it. This is not a high priority item at this point, unless we start seeing customers asking for it. But as part of our overall cost planning project, which is something we have planned for, it will solve this eventually, but we don't have a release yet for this. When we come to manufacturing, we'll go into more details, but just understand now that in case of PAC, when we do work order completion, we will always resources. Okay. Now, when you close a work order, we will know the actual material and resources that are being used. Okay. But when you're doing what we call as a provisional completion, meaning to say the work order is not closed, but we are completing some units of the item, then we have a choice of using a prior period pack for the provisional completion, or a fixed cost. Fixed cost is like a standard cost for that particular item that you can set up for valuing provisional completions. When the work order gets closed, it obviously will use the actual material and resources. Srini, tell me if I'm wrong. For 22C, these are the two values, right? Prior period pack and fixed cost. And then 22D, we will do all three, correct?
That is correct.
Right. And of course, we will cover this in more detail, but in EBS, it was slightly different in the sense that they had this notion of a material relief algorithms, and this was only for material, it was not for resources. Resources were always actual. So they could use actual materials or standard materials. Standard materials is what is coming from your bill of materials, or work definition in our language. So that was EBS process. It was using either standard materials. You can say a rough parallel of that would be you can come up with a fixed cost for it. The other option is you can actually use actual materials, which is what we covered as part of this, right? EBS only did materials. Resources was always actual, like I said, but we will actually do actuals for material and resources. In 22C alone, because of timing and our bandwidth, we are supporting for provisional completions, we are supporting prior period pack and fixed cost. And in 22D, we will actually finish having a provisional completion option of using a calculated WIP, which we support for other cost methods. For PAC alone, it might take a little bit more time, so we're putting this in 22D. But even in 22C, when you close the work order, you will always be using actuals. Hopefully that clears up the question. Period close, we talked about pending close, and in EBS, there was no notion of a pending close. So there's a new feature that we added now. Okay, I'm looking at questions. Okay, how do we provide the initial cost value and quantity that comes from external applications? Okay, let's talk about it. So when you have to establish, let's say it's a new customer. So I'm going to answer this in twofold, right? So one is it's a net new customer who is actually implementing not just costing, but they're implementing inventory also, right? So what we will do in such cases, which is true even today for other methods of costing, you will create a miscellaneous receipt with quantity and cost. And as I've explained before, in inventory, when you create a miscellaneous receipt or a miscellaneous issue with cost, we treat that as a cost-owned transaction. So the quantity would actually be instantiated in inventory, obviously, and your on-hand would be built. So that would take care of the inventory conversion. And then for cost, since we process all those transactions, you will also establish your opening PAC. Typically, if you cut over end of the month, you take that, process the transaction. Let's say if you want to go live in January of 2023, you will do all of this in December 2022, and then close the December period and then open January, in which case you will have the opening balances not only from a cost perspective, but also from a quantity perspective. Now, if you're an existing customer who's already running a different cost method, we have to talk about, we have a different thought process there, which we will explain. Sorry, there was another question that came up. So do we have any allocation partner solution already? I don't think so. We have to, if you guys have, if any of you know a partner who might be willing to work with us or build something on their own, be happy to review that solution and put it in the marketplace. Right. Trainee, I'm going to request you to talk about what happens if it's an existing customer who wants to use PAC as a, let's say, not complicating it as a primary, but just if they want to add PAC as a secondary cost book, how do you get the quantities? You want to talk about that?
So, Kaushik, I think probably it will need a little bit of background. So
Okay.
it's better that we handle it separately. So what I was suggesting in the chat is that we are working on some documentation.
Yep.
So we will provide in terms of if it's a customer who's moving from perpetual to periodic, right? Or a net new periodic customer or from a legacy system. Somebody who's using cloud but wants to try out PAC, or they're moving from legacy. So we will have 3 different options and explain what are the tools available to do that.
Okay. Perfect. So we'll have a separate session on that one then.
Right.
Okay.
I see another question on the chat, Kaushik and Srini, for Lair, that is specifically for allocations. It say, do we have a partner that already has a solution for it?
No, I mentioned it. So we don't know, at least I don't know a partner at this point, but if somebody is willing to build it, they can put it in the marketplace and other people can use it. They can actually sell it as an extension.
Mm-hmm.
Okay. But like I said, we will at some point come to it because we don't want to do that just for PAC. We would like to do it for overall cost planning as a whole, not just for PAC. That's why we didn't slot that as MVP as a capability. Okay, so that is all that I had to cover, and we now move on to the solution overview where we're going to talk about those different transaction flows and how they work. I'll turn it over to the first section would be setups, and I think Siddharth, you're going to take it over from here, correct?
That's right, Kaushik. Thank you.
So just 1 minute, a quick overview of what we have planned. So like Kaushik said, we will first talk about setup in terms of what are the PAC specific setups that you need to understand. Then we will talk about day in the life kind of a thing. During the period, what are the things that you do? So setting up cost, let's say resource cost, overhead, processing transactions and so on, reviewing your cost, looking at reports. That will be the second session that we will plan after this setup. Then the last session that Rajat would talk about would be in terms of at the period end. What are the various controls that we have? What are the things that you can do? What are the reports that you can review? What are the activities that you need to do, right? So we have tried to sort of weave a story around this. So the data that you see that is being used is constant across all of these 3 flows. So setup will talk about in terms of the various entities that we use for the demo. Then I'll talk about in terms of processing transactions, how the PAC is calculated and so on. And for the same period, Rajat will talk about in terms of how we go about period, right? So that's the broad agenda. So we will do the setup today. The other 2 sessions will happen on Thursday. Over to you, Siddharth.
Thank you, Srini. Let me start sharing my screen. So as Kaushik nicely put up, right? So he said that most of the setups that we do for periodic average costing are similar, are just an extension of what we already offer. I'll go into some of the differences that we have specific to periodic average costing versus other cost methods, and also give a sense of what are the recommended setup that we are proposing. And lastly, as Srini mentioned, I'll go through for the demo how we are setting it up so that once you start to see the demo transactions, it will kind of make sense that what was the setup already done. Right, so just a quick overview, right? I'll go over the new cost method, the PAC cost method that we are adding, right? How we are leveraging the costing setups, right? That this is now, as Kaushik already mentioned, that in release 22C, it's an opt-in feature. I'll just show the screen how it looks, how customer can opt in there. And then knowing that most of the folks here don't know about the key concepts, I'll go over the organization structure, valuation structure, and cost profile in cost management or cloud cost management. And then just quick training material documentation links follow that for offline more analysis. So for 22C, now the feature is available and it's called use periodic average costing to value inventory, right? If an existing customer can come in and enable it. I think Srini, if I'm not wrong, any new customer would already have it enabled, right? So they wouldn't have to come here and enable it.
They will have to enable it. It's not enabled by default. So if they want to use it, they'll have to come here to the opt-in and enable it.
Okay, thank you, Srini. And only once this is enabled, the setup changes for specific to PAC will be visible on the UI. So if the customer doesn't do it, it won't even be visible there. It's not that they are grayed out. They won't be visible. This is all to avoid any confusion or mistakes during setups. Quickly moving on to the organization structure, right? As again, Kaushik had briefly mentioned, in EBS, we had a concept of inventory orgs directly at the legal entity level, and then you had cost sharing through cost group. However, for cloud costing now, what we do is under legal entity, we create a new entity called a cost organization, and which can have inventory orgs only at a profit center BU level, right? So which means all the inventory orgs that are part of a cost org share the same profit center BU. Right? This helps when it comes to intercompany transfers, cost sharing, and things like that. So this is already in place. We are not changing this. And then this helps kind of nice grouping at the cost org level for customers. And then within costing, we provide the ability to have multiple books that can have different cost methods. Actually, today, the cost method is actually at item level, right? So you could have an item cost profile and use that cost profile to have a cost method and cost your item at that cost method, for example. But for simplicity's sake, let's take here that you have two books. One could existing could be FIFO and the other is standard, right? But going forward, we are adding a new book which will have a cost method of periodic average. The big difference is, unlike for FIFO and standard, periodic average is only at the book level, meaning this is not at the item level, but at the book level. So as you see, when you set up the cost book, you have an option to select whether the book is periodic average cost or not. And once you enable it, all the items will have cost profiles that have cost method as average cost only available to them, right? So there is no item that can have a different cost method that can be part of this cost book now. And like I mentioned, this option of seeing the periodic average cost, this checkbox will only be viewable if the customer has opted in. And this is where we control, and this book is where we control all the options for periodic average cost. So if the book has periodic average cost enabled, all the other things follow from there. For example, if I show a quick demo here, we'll see a few inventory orgs, how they map to the cost org for our demo and the cost book that we are going to use. Okay. In this case, for the purposes of our demo, if a primary ledger is associated with the book, it is called a primary book, meaning you can post it to the general ledger. Similarly, a secondary ledger can be associated to book, but then it only becomes a secondary book. And you can also have a ledgerless book, where that's only for analysis purposes. You don't post it to ledger. Now, when you set up your cost org, you can provide a start date, and then we generally propose that your cost org start date and your cost book start date align. And then based on that, you can define when your first open period should be, when you're actually starting to cost all the transactions. Now, all the transactions prior to your first open period are actually all brought into the first period. So that automatically happens. Nothing new has to be done there. The big difference is for PAC, only one period can be open at a time, right? Which kind of makes sense. You only want one periodic average cost available to you, and only once you close that period, the second one becomes automatically becomes open, and I'll show it in the demo how that looks. And once you associate an inventory or to a cost organization, you cannot remove it. The only way you can remove it is if you don't have any transactions. So there has to be some thought given into how you are setting up your cost organizations and associating what inventory orgs to it. And then once you associate an inventory org to a cost org and you do some transactions, you also cannot update the profit center business unit for that inventory org, right? Because we mandate that all inventory orgs in a cost org belong to the same profit center business unit. Right. So for our demo purposes, we created a demo cost org to make it easier to remember. We just called it PAC demo cost org, right? As we see here, we associated the previously created cost book called periodic average, right? When you come to the cost org relationships UI, you will see that it also shows that it is a periodic average cost book, right? To make it easier to know. And then in this case, it is our primary book. And then we are starting, our first open period will be January 2022. This will be helpful as we show you the transactions for the demo, like Srini mentioned, kind of a day in the life of a cost accountant. So now this is the concept for what is a valuation structure. Now, to enable cost sharing and to maintain costs, we have a concept called valuation structure. This defines the level at which you're trying to share costs. For periodic average cost per se, let's say we have a business which has 3 different inventory orgs. One is called the warehouse, one is called the distribution center, and the third is the manufacturing plant. We have 2 kind of structures that they can set up. One is a simple thing where the valuation structure is only at the cost org level, which means costs are shared at this level, at the cost organization level. So all the inventory orgs under the cost org, in this case, the 3 orgs, would have the same cost as shown in the table. Let's say product cost for this item, 1, 2, 3, 4, 5, 6. As you see, all the 3 inventory orgs would share the same cost. So if you run any inventory valuation reports or things like that, you will see that the cost for this item in any of those inventory orgs would return the same value. The second option that we have for PAC is the valuation structure at the cost org and inventory org level. Right. Now cost sharing is actually happening only within an inventory org. So in this case, if there are 3 inventory orgs, the same item would have different costs within each inventory organization, right? So that's a big difference. So now if you run same example, if you run inventory valuation report, or if you're trying to check the item cost, right? For the warehouse, you'll see the cost as 1,200. However, for the distribution center, because it's a different valuation structure, it's part of a different structure, and hence a different valuation unit, the cost would be different, as say in this case 950.
So in this case, I can just create just one cost organization and have each organization with its own cost, right?
That is right. Yes. Okay. But to do that, you have to set up the structure that includes the cost organization and the inventory organization. And I will quickly show you how it would look. So basically, this is the valuation structure. You go to the manage valuation structures UI, and when creating a new structure, in this case, let's say it's called DCST INV org asset, because we are creating an asset valuation structure. We include both these attributes, the cost organization and the inventory organization. And by default, cost organization is always required, right? In this case, even if you turn off inventory org as not required, it would not matter because all the transactions anyways would bring inventory org with them. But it's always nice to keep it required because that's the intention, that we want to share the cost only within the inventory org right now.
Okay, clear. Thanks.
Sure. Was there another comment? If not, yeah, I'll move to the next one. So here, the thing to remember is for again for cloud costing, we define the structures separately for the asset type and the expense type. Which means if you have an asset transaction, it will use the asset valuation structure. For the expense transactions, meaning if the material is issued out of an expense sub-inventory, or if the item itself is an expense, right? Then it would use the expense valuation structure, right? Again, this is the structure that you are defining at which you want to maintain the cost. This is not the actual unit that is storing the cost. Okay, and I'll show what I mean by that when we go to valuation unit. So the next part is once you've defined the structure, you will come and try to define your cost profile. So cost profile is is what is associated, which takes the valuation structure and it gets associated to an item to really define what its cost method would be and other related cost policies. In this case, if you intend to use this cost profile in the periodic average cost book, you have to make sure that the cost method is selected at periodic average. Right, because you can define cost profiles for other cost methods, right, like standard or perpetual average or FIFO. Now, if you do that, those cost profiles will not be eligible for this periodic average cost book, right? Because we already have set things in place that will make sure that a customer doesn't do a mistake, or we don't pick up a cost method like standard for a periodic average cost book, right? Because that has potential to mess things up. So other important cost policies include you can define what your unit of measure should be for that item in that cost book, whether you want to cost by the primary UM or the secondary UM. Okay, choosing secondary UM means essentially that you want to account for catch rate requirements, right? If your item is dual controlled, then it would make sense. Now, to avoid a lot of noise in the system, meaning you're doing a lot of, let's say, sub-inventory transfers or direct org transfers between these inventory org, which are part of the same cost org, all those transactions will be costed at the same periodic average cost, right? Again, because they are within the same cost organization. Now, in that case, to avoid transactions that use the same cost to issue and receive, right, or deliver, we propose that you turn off or make sure that you don't enable those to be costed. For example, in this case, if you have a lot or serialized item, we're proposing that we keep summarization as enabled, meaning it will create a consolidated transaction at the transaction level and not explode it at the lot and serial level. So yeah, that will help keep the volume down, make reconciliation easy. And then the next one, similar to that, similar to that is this account intra-valuation unit transfer, right? We suggest that you keep it as no. Again, if you are transferring within valuation unit, it will have the same periodic cost. So not accounting it just keeps the system noise down, makes it easier to review transactions again, and it has no financial impact. Just continuing with the cost profiles, for scrap, we will discuss these more when we get to, for manufacturing, we'll discuss more for scrap the options that we have. But for RMA, we propose that we use the existing item cost. This is the idea is any unreferenced RMA that we get, we just use the average, the current periodic average cost. And yeah, so those are and right now, as per our design, For operations scrap accounting and operations scrap valuation, probably these are the options that we're currently supporting. For scrap accounting, we want to include in inventory, and then for scrap valuation, value immediately at work order close. And for provisional completion, we are going to use the prior period cost. Let me see any other questions. I think Srini, you're taking care of chat. Thank you. Now, this is where, for the demo purposes, we are defining the cost profiles. So we have defined two cost profiles here based on the suggested options that we showed. One is called the demo pack for the asset valuation structure. Sorry. And the other is the demo pack expense for expense valuation structure.
Siddharth, I think it might make sense to go back to that slide on cost profile and ask if there are any more questions.
Sure.
The previous one, I think there were questions about negative inventory. So
Okay.
just to give you a quick background, negative inventory option is something that we support in other cost methods where there are three options. One is never, one is always, other one is to zero. So the user guide has basically the examples in terms of how these various options work for the other cost methods, which is standard, average, and perpetual. For periodic average cost, we have taken a conscious decision that inventory system is the only system that will control the negative inventory option. So if a transaction is allowed by inventory, we process it. If the customer does not want to have negative inventory, then they can set it up such that in the organization parameters to say that don't allow negative inventory transactions, they will never come to costing. So that's the thing that we wanted to highlight here. So if you're familiar with how cloud costing works and how cost profile works, there are three options for other cost methods. One option, which is always, which is like as good as use the negative inventory option provided by inventory. That's a default option.
My question was because I know that this setup is done at the organization level, but here you are showing the definition at the cost profile level. That's why I asked the question. I do not understand which one will take priority.
So actually, you could ignore this particular option, right? So it basically it says defaulted. So we don't have to worry about it. If the priority is always what you set up in inventory. If the inventory organization parameter allows negative inventory, then costing processes it. If it says that do not allow negative inventory, the transaction never comes to costing. So the option here does not really matter.
Okay. Thank you.
Are there any more questions on any other parameters? Okay, thanks for that.
Thanks, Amy. Yeah, so moving on, now that the cost profiles are defined, the next step for setups is that we take those and create what is called default cost profile, because defining these makes it easier for a customer to for the items to automatically generate item cost profiles. Because what you don't want is to go to every item and associate an item or associate a cost profile with it. So defining default cost profiles does it for you automatically. Now, like I said, cost profiles can be associated manually, but defining default cost profiles just makes it easier for the program to do it automatically for you. Now, we do give some options to the user on how these cost profiles should be associated to the item when it comes to running the cost processes. The options are, you can say that all the items in a cost organization should pick up the defined cost profile, or it can be a cost book level, or it can be a costing item category level, meaning for a particular set of items, you want to give them some cost profile. For different items, you want to give them a different cost profile. So that's the idea. So those things are already in place. We haven't changed those. So the next thing is how these cost profiles are actually associated to the items when you start to see transactions coming in. A bit of it I already mentioned. For example, you have an asset item in an asset sub-inventory, it will use the asset cost profile. but the same asset item coming out or going into the expense sub-inventory will use the expense cost profile. However, an expense item will always use the expense cost profile, either it's from a asset sub-inventory or the expense sub-inventory. Now, the next thing is expense destination flows. Expense destination flows don't even come into cost management, so the cost profiles are not relevant to them. They are only processed in receipt accounting. And the same is the case for description-based items. They don't come into cost management. They are handled completely in receipt accounting. However, there is, I think, description-based items to WIP, work in process destination or manufacturing destination. Those we will handle separately when we get to manufacturing TOI. So here, once you have set up your default cost profiles, all this is showing is for a given these three items that we'll use for the demo: AS72111, AS92888, and GCST plain asset one. For these three items, we are going to use the default or the asset cost profile that we had just set up in the demo, and the expense is also associated to it as part of the item cost profile, which means all these three items are actually asset items. Now, if only if they are issued out or received into an expense sub-inventory would the expense cost profile be used. Otherwise, the cost will be maintained at this cost profile level. They'll use the valuation structure as defined in the cost profile. Just a few considerations here. Yeah, we want to make sure that you don't set up too many cost organizations, meaning try to think of the setup that you want to do, because if you have too many cost orgs and each cost org, let's say, just has one inventory org, can lead to a large volume of transactions that's transferring between the organizations, or let's say those summarization options or intra-valuation unit transfer options that we mentioned. Those can increase the number of transactions or noise in the system that makes it difficult during period end. But at the same time, when you have a lot of organizations also, you have to close periods for each org. So it increases administrative tasks. And yeah, once you have a transaction in the system, you cannot go back and change the inventory org association to the cost org. So yeah, thought must be given what the business process is, how you're going to structure your cost organization and associate what inventory orgs within it. So lastly, I think there's two more demo slides. One is the accounting overhead rules that we have set up here for the purposes of our demo. So we've set up a rule called PAC demo rule 2 that we'll be using for the demo. The expense pool is P2P expense pool, and this is the cost element that you will see. The idea here is for any miscellaneous receipt transaction that comes in, we'll automatically use this overhead rule, especially for this item. Srini, I don't think so. I have a slide to show what the rate is for this. I think we can mention it when we go to the demo.
So when we will talk about the cost processing, we'll talk about it. The idea here was to basically say that as part of the initial setup, you will also define overhead rules. So these are multiple rules where you can define them for groups of transactions. So you see here, there is something called inventory transaction, sales orders, purchase orders. So you can do it for a group of transactions or a specific transaction. And there are some versions that you can talk about. So we will cover that in the subsequent cost processing session.
Right. Thank you, Srini. And then for our demo, like I said, our first period was January 2022. So right now we've set the status to be open for our org that is PAC demo cost org, and the book is periodic average. So when we create, when we want to run cost processor, we need to create something that's called a run control. Run control essentially is just a setup for what
Siddharth, can you just go back to the previous slide? Just wanted to add a couple of things here. So this is the central page from where you manage the periods. So there are multiple kinds of things that you can do. You can open a period. You can, like we talked about, different statuses. So remember that process flow diagram that Kaushik showed. So there are different period statuses. There is pending close. There is close, permanently close. So there are business rules for each one of these, right? So when you start your initial implementation, you would first decide, like Siddharth talked about, there is a first open period, right? So let's say, for example, we have selected it as Jan 22. So from Jan 22, you can start managing your periods. So Jan 22 right now is an open status. Only when you close Jan 22, you will be able to open, like permanently close Jan 22. Only then you will be able to open Feb 22. You close Feb 22, you move on to March and so on. So this is a single page from where you can do all of those things. You can also do a bunch of what we call as period end validations. So you can do this as when you are changing the statuses. Rajat will cover this in a lot more detail. But you can also run this during the period. Anytime during the period, you want to ensure that all your transactions are fasted, you don't have any errors and all of those things. So anytime during the period, you can run the fast processor, you can run the period, the validations and so on. They also get triggered when you move the status from open to pending close to close, close to permanently close and so on. So these would be covered in a lot more detail in the period end session, but sort of explain that this is one page from where you can do everything. Thanks, Siddharth.
So thanks, Srini. So yeah, the question just came in about the valuation structure. So yeah, so the valuation structure is assigned to a cost profile, which is essentially assigned to an item, which means in a PAC cost book, you could have one item that has sharing at the or the structure at cost or, whereas a second item has valuation structure at cost or plus inventory or. So that is definitely possible. So Alexander, does that? I hope that answers your question. Okay, I'll move on then. So like I was mentioning, so now to run the cost processors, right, which is to run the pre-processor, the actual cost processor and things, you have to set up something called a run control, which is gives us a control to define what processes you want to run, what is the commit limit, and also till what time do you want to process the transactions. For other cost methods, you can actually come in and set up a cost cutoff date. But for periodic average costing, for PAC, this will all automatically be set up to the last day of the current open period. For our purposes, like a cost org is demo cost org, and for the periodic average book, we can see that right here also we will display that this is for a periodic average book. Hence the period will be displayed here. And then the status of the period is also visible, because like Srini mentioned, those are important steps. You want to know what the status of the period is as you move on with your let's say period close, as you move on with your month, and not having to go back to the previous page where you saw the periods is an important thing, because you want to keep the business running and not just keep changing UIs to figure out what's happening. So the period status is also visible. And then by default, we provide an option that as you close the period, the same run control will move on to the next period and show the next period, which means, and I guess Rajat will show this in the demo. Let's say we start with the January 22 period as open, and we move it to pending close and then final close. When it is final close, and we have this setup already there to automatically update the period on run control. On final close, this period will automatically become February 22, and the period status will be open for that. This helps maintain the same run control that a customer sets up, so that they can put it on a schedule. Let's say they want to run once a day, and they don't have to come back and just change it because the period has now been closed, or to update the run control or change the period on it, or any such things are not needed. The system automatically takes care of that. Yeah, I think that is the last one. Yeah, if no further questions on setting up run control, I'll give it back to you, Srini.
Thanks, Siddharth. So
Quick time check, because we have to join the other executive day call. So maybe we should. Is there a good time to let people ask questions, or do you have other things to cover? I think.
No, I think we are done for the planned content. So we can take some questions for another 5 minutes. So Kaushik, you wanted
yeah, I think the questions might be worth repeating. So I guess there was a question that you already, Siddharth already answered about can different items have different valuations of units. I think that's doable, as long as it is within the confines of cost of an inventory org. There was a question on run control, which I think Rajesh just answered. And some of these UI changes that you would see in which we were showing is enable via opt-in, correct, Srini?
That is correct.
Right. And then,
so they will not appear even in a 22B instance. If you have access to 22B instance, these changes will not be there. 22C, once you have, like Rajat had explained, once you have enabled the opt-in, then you can start seeing these changes.
Right. And then the run control question about the cutoff date is automatically from the last day of the period. I think you answered that. So that, and the answer is yes. Other questions were around
what you can reiterate the consign thing, Kaushik.
Consign, I think, was answered. So
okay,
nothing of what we're doing in PAC is changing consign. And then there was another question about what is prevented when the periods are closed. I think Srini answered that question when it comes to prior period transactions. So when you set a period to pending close, you would not process further transactions into costing from inventory. This doesn't stop you from performing inventory separately. But what will happen is if you close the period and you get a prior period transaction, the date of that cost date of that transaction gets bumped up to the first of the next open period or the next open period. So that's what happens. So which means from a cutover procedure, from a month-end close procedure, you want to make sure that there is a handshake between your supply chain functions and accounting, so that way you don't end up with too many of those transactions, which kind of gets bumped up, right? I think there was a question on overhead and resource rates for a period. We will cover that in the next meeting, correct, Srini? On Thursday?
That is correct.
Yeah, and there was one more question, which is allocations is not big. Most customers in manually. Okay, fair enough. Does PAC consider recoverable and non-recoverable? Yeah. So the thing is, anything which is part of acquisition cost today. So PAC is not changing the construct. So the non-recoverable taxes today, from a Brazil standpoint, or for the matter any other country, is considered as part of acquisition cost. So anything which is, specifically for Brazil, we use a module called fiscal document capture, right? You guys are all aware of it. So when FDC creates the transactions in receipt accounting, and then that flows into cost accounting, recoverability is already known, and we will take the non-recoverable portion of the tax as part of the item cost. So that's already handled. PAC is not changing that. That's already there. I'm trying to scan other questions which might be worth repeating, Srini. I think we said conversion will have a separate conversation on. I think that is it.
So there's a question on COGS and DCOGS. They'll work the same way as other cost methods. Yes. Krishna's answered in the chat.
Question, Krishna, I think you answered that one about complementary invoices. Do you want to speak out and answer that?
Sure, question. Sorry, you guys can hear me?
Yeah.
Yes. So the complementary fiscal documents, I think as I was updating in the chat, and I think Kaushik also just mentioned that we have a product called as fiscal document capture, which is used to basically capture all the fiscal documents that comes in. And these complementary fiscal documents are captured in the FDC, and they get interfaced to payables as correction invoices. And once that interface happens, they in turn comes to costing. And they come as because these are like the correction invoice or the price complementary, they come to costing as the invoice price adjustments or as part of the acquisition cost. So net, yes, those price complementary are brought in back into your PAC. And I think we'll have a different separate session on the whole acquisition logic, right? Depending upon whether this particular complementary fiscal document will come in the same period or in a different period. And that way, depending upon that, I think there is a formula that will be shared. I think we'll have more discussion then, right, on exactly how those values will be impacting your periodic average cost calculation.
Well, thank you, everyone. I saw many questions about the presentation and if we share the information, and the answer is yes. I will organize with Trainee to open a workspace to and share the information. And I don't know if someone has another questions or requests. If not, I believe that we are finishing our first session. We will have another session on Thursday to the same hour in the same Zoom link. And I just want to say thank you again to Kauchik, Srini, Siddharth, and for the presentation and to share this information for us because it's very critical for Latin America and especially for Brazil.
Thanks, Alfonso, for helping us organize this.
Okay, Alfonso.
No, thank you. Well, and thank you everyone once again. So we'll see you again on Thursday. And if anyone has another question, maybe we can recap and take in again on Thursday in the second session. Okay?
Thank you. Thank you. Bye.
Thank you.
Okay, thank you everyone.
Thank you.
Recording
Bye.
stopped.
Thank you. Bye-bye. Have a nice day.